Hello there, everyone, and thank you so much for joining us today. I'm Sam, and I moderate these weekly webinars. First off, Happy New Year. We hope you've had a wonderful and safe and healthy New Year. In just a second, we're going to be joined by Patrick Ray, one of our retirement-focused advisors here. Patrick is going to be giving you some tips on how to correctly plan your Roth conversion in 2025, as well as some tax saving tips to help you with that. Afterward, I apologize, we will not have time today to answer any questions, but I invite you to still ask away. It's completely anonymous, and we'll make sure one of our advisors can address those questions with you either through phone or email after this presentation has ended. Throughout the webinar, you're going to see some links popping up on your screen. Those will be from me. They're gonna guide you to our calendar where you can book an appointment with either Patrick Ray or one of our other retirement-focused advisors, as well as links to our YouTube and our LinkedIn, where you can follow us. We invite you to please follow us. We post tons of retirement-related content weekly, and we really think you'd get some value out of giving us a follow. So thank you in advance if you decide to do so. As we wait for a couple other people to trickle in, I'd just like to also remind you that we are not affiliated nor endorsed whatsoever by any specific company. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along. And without further ado, let's jump right into it with Patrick Ray.
Hello, and welcome to today's discussion. My name is Patrick Ray, and I am one of the senior financial advisors with the Retirement Group and the Wealth Enhancement Group. And we appreciate your attention today, where today we're going to talk about not just what a Roth conversion is, but some avenues of how to funnel and get money into a Roth growing tax-free for the upside of the tax-free growth and the fact that you don't have to take minimum distributions and all the other upside and benefits that we get from having money in and located and planned into a Roth IRA. So on a Roth conversion basis, there is a strategy that allows you to bypass Roth contribution limits. And the way it works is by making a non-deductible contribution to an IRA and then immediately converting that into a Roth IRA. And so what this looks like is for us here having an income bucket, and for many of you on the call today, we make too much money to contribute directly to a Roth IRA, which then means that we have to look at alternatives. And in this case, you're allowed to make a non-deductible contribution to an IRA and then convert that immediately. And so you're at liberty to do this as frequently as you wish, as well as you could do for your spouse. And so by definition, if you started this planning process and technique soon enough, you could reasonably contribute and get monies growing in a tax-free environment under the Roth IRA process on a very noticeable basis. And so the sooner you address this potential planning topic and planning privilege that we have, that we utilize often here with the Retirement Group, is the sooner we can get money not only growing tax-free, but we can continue to build off of that as we work towards a time where we exit the payroll and go off into retirement. Now, there's another avenue that could be utilized, assuming that some certain criteria is met, and I'll talk to you about that in just a moment. But there's a strategy that allows you to contribute up to $46,000, $46,500 to be specific, over and above the $23,500 limit if you're over the age of 50 on an after-tax basis into your 401k. And you could consider doing that in addition to making direct contributions to your Roth IRA, assuming that your income allows you to do that, and or considering adding the process or plan that we just talked about, which is the ability to make a non-deductible contribution to an IRA and then convert that to a Roth IRA. So there's some requirements under the eligibility program for your company that you need to consider to be able to do this. And one of those things is that there has to be after-tax contributions allowed in the plan. And so it has to be above and beyond the $23,500 pre-tax contribution limit that's under today's rules. Your plan also has to allow in-service distributions or non-hardship withdrawals, or what they call general withdrawals. And you also have the ability, as far as your plan is concerned, to consider an additional $7,500 in the event that you're over the age of 50. And so the way this works is to consider potentially maximizing your after-tax contributions to the 401k, and then immediately or as soon as you can, moving those after-tax funds out of the plan, in fact, in many cases, while you're still working, and roll the after-tax principal directly into a Roth IRA. And then if there's any earnings throughout the year when you allow to do this, because many times we wait until the end of the year where there's some substantial monies that are allowed to be moved into the Roth under this privilege where you can do so. And it allows us to do that once a year on most plans. And so in doing that, if there's earnings on this money, you can take those earnings and move those into a traditional or rollover IRA. And so from a planning perspective, it kind of looks like this, where you take your pre-tax employer contributions under your 401k based on the limits, and then consider the after-tax contributions in this case, $44,500. And so in this case, 2024 allows you to put in a total of $70,000. And I know some of you may be asking yourself or thinking to yourself, why on earth did I either A, not know about this, or B, how would I figure out how to do this? And we'll talk about some strategies about how to potentially employ this, assuming that your plan allows you to do that here in just a moment. But what it looks like is getting this $44,000 of after-tax contributions moved directly into the Roth IRA and doing that as soon as possible. So, of course, it takes some time to actually contribute that much money in a given time frame over the course of a year. And so, as I mentioned, typically this happens towards the end of the year. And often many of our relationships while individuals are still working are started by helping them with this planning process and getting that money invested according to their overall financial goals and their investment objectives, and getting that money on a tax-free basis growing in Roth IRA as soon as possible. And so what we need to consider is the end result of how this may benefit you. And so, of course, we got to be cognizant of the taxation, of how the withdrawals work and the way the planning process works. And so under the 401ks and your IRAs and other tax-deferred accounts, we can consider many of these options after age 59 and a half, because basically all we have to do is consider the tax implications, which in most cases are current income, if you decide to do some conversions after the age of 59 and a half, of course. But we also got to consider the future planning process, especially if you can afford to potentially defer any of the distributions from your IRAs or keep them minimal until you get to mandatory distribution age, which for some of you will be age 73, but for many of you, if you were born after January 1st of 1960, it will be age 75. But this is also something that we want to take into consideration when we're trying to build a plan on what it looks like to convert, or which of these options, maybe all of them, to consider if we can afford to do so. And on the Roth IRA side, we're talking about, of course, penalty and tax-free money after your Roth IRA has been open for 5 years, where we don't have to concern ourselves with mandatory distribution options, and that money grows tax-free for not just yourselves, but for your beneficiaries as well. So on a summary, the Roth IRA conversion may be a good idea for you if you expect to be in the same or even a potentially higher tax bracket during retirement. Now, I know many of you think, and I've heard this countless times over my 20 plus years in the business, and talking to folks about the process of planning for retirement, and them thinking in terms of they're going to automatically be in a lower tax bracket. And experience tells me that oftentimes that's actually not the case. And so if that's true, when we consider taking withdrawals from our 401ks and our IRAs, and we have pension funds, as well as starting Social Security, which some of you may not even know that that's taxable as income, depending on how that lands on your tax return from a household income perspective. So we're paying some potential income taxes on our Social Security benefits, as well as taxation on our pension benefits and our 401k withdrawals and our IRA withdrawals, etc. So many of these things need to be considered when we're talking about or trying to plan for a Roth conversion strategy. And if you're in the same or projected to be in the same or a higher tax bracket during retirement, this would be one of the conversion factors to consider, or be a good idea to consider anyway. And then you won't need the converted funds for at least 5 years. That's another factor. We want to make sure that if we're converting money into, especially if it's a brand new Roth IRA, that money has to sit there for 5 years for you to be able to enjoy the tax-free withdrawal privilege for the earnings and the principal that you have. You can always have the access to the principal that you put in without any tax problems, but the growth is what has to be monitored for at least a 5-year window for that to happen, to check the box under the IRS codes. And then we also want to consider the ability to pay the tax if we're talking about converting money, because that's an immediate taxable nature or a taxable income event that we have to account for. So, of course, having money in a savings account or a checking account, or making sure that we have plans where we're not removing money from other retirement accounts to, in fact, pay for the taxation that's due on these would be a huge benefit to consider if we're going to consider the Roth IRA conversion strategy. And if we consider these strategies, it can provide you with tax-free earnings on the qualified withdrawals from your IRAs, which are all tax-free. And of course, as I mentioned, there's no minimum distribution considerations for that bucket of money, as well as you can leave that money in there growing tax-free for the rest of your life, which also may benefit not just you, but your beneficiaries, of whom whoever ends up with the funds after you suffer an untimely death. And so what we would encourage you to do is to reach out to a focused retirement specialist, something that we do to help people, because every single person's taxation situation is absolutely different. And we know from experience that 74% of people over the age of 50 do not have a written financial plan. And frankly, there's really no excuse for this, because we do this as a way to introduce our services to you free of charge. So this is a complimentary service that we walk people through so that they can get familiar with how we deal with people and what we talk about with our clients and prospects, as well as understanding if you do or are looking for a partner in retirement, to see if it's a good fit to work with one another. And so why would you consider the retirement group and the wealth enhancement group? Is because we have a ton of knowledge and experience on the team working with and experience in helping corporate employees transition into retirement, which, by the way, is the second most stressful event that anyone will ever have to go through. And unfortunately, number one is losing a spouse. And so this is not only a timely situation to deal with, but it takes a lot of planning. And the more planning that you do, the more comfortable the road to and during and throughout retirement ends up being. We have offices across the country, and many of us have unique knowledge to your 401k plan and pension plan benefits and your medical plan benefits. And so this is all things to consider on why the retirement group may be a good fit for you and your family. And as I mentioned just a moment ago, we offer a complimentary cash flow analysis for a way to get the discussion with you and your family started. And so if you have questions or you'd like to reach out to us, you can do that in a number of ways. You can reach out to us by email at info@theretirementgroup.com. You can call our 800 number, which is 800-900-5867. If you have a smartphone, you can take a picture of this QR code to the left, and it will get you access to a calendar where you can schedule time with myself or any one of my colleagues to pick a 15 to 30 minute window that might work for you to start a discussion, or maybe we can talk to you specifically because you have a specific question about your own personal circumstance, which we're happy to talk to you about. And then if you're not already following us on LinkedIn page, on LinkedIn, we have many pages on LinkedIn that are directly correlated with companies that you may be working for. And I encourage you to follow us on those pages, because we have updates on a regular basis about not just material that are relevant to things that are dealing with your benefits in the event that you work for one of these companies, but we also put out new updates and webinars of things of this nature to be notified on. So I encourage you to check us out on our LinkedIn page if you're not already doing so. And so with that, I will certainly finish up by just kind of talking for a second about the importance of the planning process. And being involved in the financial planning and financial services business for over 20 years, the one takeaway I've been able to manage to the greatest degree is the folks that I've been able to talk to and our team has been able to meet with and plan for their exit into retirement long before they ended up leaving the payroll. And so the sooner you put some time and effort into this planning process, the better off that you'll be long-term for sure. So with that, I will leave you for the afternoon. Thank you very much for joining us. I hope you found some value in what we had to talk about today. And until next time, we'll talk to you. Take care.